Hello and welcome. The topic for the presentation is Statutory Liquidity Ratio or SLR. So moving on to allocation of bank deposits. Now the bank deposits are mainly segregated for three purposes. First, cash and bank balance. Second, government-backed securities. And third, loans and advances. So all the deposits in the bank, they go into either of these three points. Now cash and bank balance and government securities are way liquid than loans and advances, but the first two, they do not get any interest return for the banks, whereas loans and advances, they get a substantial amount as interest for the bank. Now let us go to the definition of SLR. SLR is the fraction of total net time and demand liabilities in form of liquid assets like government-backed securities, precious metals, cash, etc., which banks have to maintain at all times. Also, it is statutory as it is backed by Section 24(2)(a) of Banking Regulation Act 1949. Further, it is fixed by RBI depending upon the prevailing market conditions, and each and every bank has to adhere to it at the end of each business day, failing which the banks will have to they will have to pay interest to RBI as a penalty. Now, so what is the significance of SLR? SLR is thus considered to be a potent instrument of credit control. It also acts as a cushion against any shocks which can lead to bank failures. Also, it helps financing various government deficits. But SLR, as it is not changed very frequently, so its role to control credit is highly limited or undermined. Also, the major functions is thus considered to be financing the various government deficits. For forms of liquidity, now the banks can maintain their liquidity in various forms. These could be cash, which is the most liquid of all assets, gold, which is owned by the bank, balance with the RBI. Now this balance with RBI, it is interest free, that is RBI does not give any interest to the banks for keeping balance under SLR with it. Then net balance in current account, and finally investment in government-backed securities. What happens if SLR is reduced? This was suggested in one of the reports of Economic Survey 2014 that there is a need to bring down the percentage saved as SLR. So the first effect will be that it will change fund allocation pattern of banks, which will lead banks to invest in lending to get more returns, because as banks under SLR have to keep a huge fraction of assets in form of SLR, and they are not able to invest in better avenues. And lastly, if SLR is completely abolished, government borrowing programs, at least in India, will be severely hit. So with this, we come to the close of the presentation. Thank you.